All right. This is the first training for the year, and I know we took a few weeks off, so apologize for that. But part of it was Christmas, New Year's, and then I had a little event for my son that I had to go to Orlando for, and I appreciate everyone's patience as we get back into it. We're going to start out with kid gloves, so to speak, just going through some of the simple fundamentals of understanding life insurance in general. The idea being an opportunity for us to ultimately get to a spot where admit all, let everyone in. Okay. The idea is ultimately for us to get to a spot where we can, understand the terminology. It's one thing to, sell product. It's another thing to actually understand what you're selling. So we're going to start with fundamentals this week of life insurance. Understanding term versus traditional whole life. Next week we'll start talking about universal life, like traditional universal life, and also IULs, and then we'll continue to grow off of that. So I have almost 52 weeks worth of content in regards to trainings, and you'll see a calendar on the Valor Financial Specialist website in the near future for that as well. Also, keep in mind that what we have today and what we have for every Thursday is training from a standpoint of sales ideas, fundamentals, and product like carrier product and things like that. I also established Wednesday evenings at 8 o'clock Central a back to basics course. So if you're looking for an opportunity to come in, ask questions, talk about case design, we had about 20 people, 15 to 20 people each time so far, where we just talk, ask questions, create dialogue. So that way you don't just hear me pontificating the whole time. God help you guys for listening to this for an hour, but it's really good. First time we talked about term insurance, living benefits. Last night we talked about actually getting registered, through NIPR, registering like an LLC. What's the process? Non-resident versus resident, and other, scenarios from that standpoint, like getting appointed with the respective carriers and things along those lines. So again, if you haven't gotten into the groove with Wednesday evenings and you're looking for, a time to do case design, I'll go for as long as people want me to go. And it's going about an hour and a half both times so far. But if anyone has, case design process or things they want to talk about on Wednesdays, more than willing to do that. So enough of the commercials. Now it's time to get to the nitty gritties, and let's kind of dive into, the originals, the originators of life insurance. When we talk about term and whole life, again, talking about traditional whole life, we're not talking about permanent insurance. So the goals for today: gain a clear understanding of the fundamental differences between term life insurance versus whole life. What are some of the advantages and disadvantages of each? And remember, a lot of people on this call might have started in a prior organization or prior organizations that really didn't favor whole life. But I posted on Facebook the other day that there really is no bad products, just bad agents, because the problem is a lot of times people want to have a bias to a certain product simply because that's all they can sell. So here at Valor, we're going to elevate our game, understand the differences and reasons why some people might buy certain products as we continue to go along. But it's always important to understand what you have available here from a product suite standpoint. Carrier specific product features. What are some of the features inside of these products that can benefit individuals? And then ultimately, how can you empower you as agents, the opportunity to have the confidence you need to talk to clientele? So apologies that you guys are seeing me admit people, but I'm an army of one, and I'm on my laptop. I'm not at my computer, so apologies that you'll see, people jumping in. So again, what is life insurance? Really, it's a financial agreement between an individual and an insurance provider. I know, again, this sounds very basic, remedial stuff, but it is a contract, and there is, contractual agreements that are in place with this opportunity. So you'll see, for example's sake, all these documents that you get from an insurance company, usually like 40, 50, 60 pages, and again, that's all the documentation basically saying, once again, there's an agreement to pay if within the parameters of say a passing or living benefit issue, the opportunity to pay out. Um, so what I would say is that you have two different types of basic insurance. You have term life insurance and you have whole life. We're going to say in general now, whole life insurance is a wide array. There is traditional whole life, and then there's also the universal life chassis. So there is a difference now, but this was the beginning. And I remember a joke that I heard one time. I think Woody Allen said it. He says his own personal hell is having someone explain the differences between term life insurance and whole life. So here we are in Woody Allen's personal hell, talking about the differences between term life and whole life insurance. Any questions you have, feel free to put them in the chat as well. More than willing to talk about it during the process or after all is said and done as well. So we look at term life insurance. Term life insurance offers coverage for a defined period of time, typically ranging from 10 to 30 years. Now, you're going to have carrier specific benefits for certain carriers. For example's sake, we have carriers that can go all the way up to 40 years. We have some carriers that can go to 35 years. We have some carriers that can go 10, 15, 16, 17, 18, 19, 20, 21, all the way up to 30 and then 35. So when you say generalizations, though, it's usually 10, 15, 20, and 30 is usually the most typical term insurance platforms that you'll see. And the idea or the agreement that you have here is you have a specific duration of time, you have a specific set of premiums set for that time frame, which are very affordable. A lot of people, the stigma of term insurance nowadays, everyone thinks it's so expensive. It's never been cheaper. You have more and more companies trying to fight to get to the top of a spreadsheet, and you're talking like pennies of a difference to get to the top. But what you'll see here is that it has become more affordable for people now versus ever before. And ultimately, as we talked about with the agreement of an insurance policy, pays a tax-free death benefit to beneficiaries upon the passing, but it has to be within the duration of what this contract says. On the flip side, we talk about whole life insurance. Now, I often ask people when it comes to riskiness of products, and when you have, say, for example, sake, a spectrum of risk, a lot of people will think that term insurance is not risky. However, I would say it's probably the most risky product because I'll throw the question out there. If anyone wants to answer it, feel free. I'll give you, 10 seconds. But from the statistics, what's the percentage of policies for term insurance that actually pay out? Feel free to shout it out if you want. We got a chat. You are correct. 2%. So when you think about that, yeah, you went over Rosendo. Sorry, it's 2%. Price is right rules. You got to go lower, but it's 2%. So it can be very profitable for the insurance company to sell term insurance. But on the flip side is that tells you something. It's an extremely risky product, from the standpoint of actual payouts. So if I said to you, because some people will say, well, permanent insurance is so expensive, I always flip back and say, well, if you tell me the exact day you plan on dying, I'll give you the perfect insurance for that. We don't know. We just don't know when the time frame is. But the idea I feel in term insurance is something that's to help you prepare to ultimately convert that to a permanent policy like whole life insurance. So with whole life, the duration providing coverage, it basically provides coverage for the entire lifetime as long as premiums are paid. Now, in certain scenarios, some carriers will have a short pay. So, as we looked at the term insurance at 10, 20, 30, for example's sake, you have to pay for that entire duration of time. Whereas if you look at, for example's sake, whole life, I can do a 10 pay with whole life and still have the policy paid up for the rest of my life. Now, on the flip side with that, typically the premiums are a lot higher than, say, a term life policy, but they do remain fixed. They do remain guaranteed. Some of the benefits of whole life, guaranteed premium, guaranteed death benefit, and guaranteed cash growth. It's not a huge, spike of cash growth like you would see in the open market or say an index universal life, but there are some people who like that tried and true policy that they can stick in their top shelf and know that they pay their premiums to a set duration of time, and then you're going to see, some type of cash value growth. So, some key differences here that we look at between term and whole life. You have the coverage period, so 10 to 30 years. Again, some carriers go to 35, some go to 40, versus whole life, which is lifelong coverage. Now, in this scenario, what I always like to say as I'm talking to people and we're trying to figure out the need, because it's need first always. Someone has a need, say, of $1 million, or I like to tell people, think of a number. This number is 10 times your income plus whatever you have left on your mortgage. And if you have any kids, 150,000 per kid, what would that number be? And some people will tell you million, some will say two, some might say 500K. But then you have the situation here where you want to meet someone where they're at. They probably don't know our type of lingo, so you have to give them something that they might be able to equate to. So if, for example's sake, you talk about premiums and you think about the premiums giving you the standpoint of lower premiums, think of it like renting an apartment. You have lower premiums that are fixed for a specific duration of time. You are in that policy for a specific duration of time, or as long as you pay your premiums. If you stop paying your premiums, your landlord will kick you out, i.e., the insurance company will lapse your contract. But on the whole life side, the premiums are higher. You're buying a house, you're buying equity inside of this product. So you're actually investing, and I hate using the word investing, but you're adding value to this policy in case you need it, much like you build equity inside of a house. So that's again where you want to meet someone where they're at. Some people actually like understanding the differences, but you have to use phrases and terminology that they can understand. So when you look at the death benefit pays only within the duration of term. So once again, you talk about risk. If you continue to pay your premium all the way up until the duration is over, then you die next year, nothing is given. Or if you stop paying premium, much like or unlike permanent insurance, you might be able to skip a year and still have that death benefit in case something happens. So a huge situation there. You miss premium payments on term, and all of a sudden you lose your policies. So that again leads back to that risk factor. There's no cash value build up, much like an apartment. You don't gain any equity inside of an apartment, but with the whole life insurance, you build cash value over time and very limited flexibility, if any, with term. But you do have flexibility with permanent insurance. So looking at the pros for term, affordable premiums. So I could get, say, a 30-year-old, 250, $500,000 in coverage, probably very cost efficiently, say, like 30 bucks a month, depending on their health, of course. Simplicity, it's straightforward. You give me money, insurance company, I give you death benefit for a set period of time. There's no, cash involved there. And it's very simple and basic. It does provide options to choose from various different term lengths, but that's about as flexible as you get. The cons are, as we already mentioned, there is no cash value, no savings component to it. Again, not a fan of saying using life insurance as an investment because you don't want to get caught against someone who says, well, how does it compare against the S&P? It doesn't. It partners with it, but it doesn't compete against. There is an expiration time frame. So either you stop paying on it or, you hit the duration, the end of the duration, or sometimes you'll see on illustrations, you'll have renewal costs. So you hit 20 years on a 20-year term, and then in year 21, you can pay the same premium, but they'll drop the death benefit significantly, or they'll keep the death benefit where it's at, and you pay a much higher premium. So from that standpoint, you have to understand that there's going to be changes in regards to after the guaranteed period. Whole life, the pros of whole life, you have guarantees of financial security for your entire lifetime. Typically, you're going to have a mutual company that's been around for over a century. So a lot of people like that track record. You'll have cash value growth inside of it no matter what. So when, 2022, when my 401k became a 201k, you won't have that issue. I know IULs will give you a 0% floor, but in the flip side is that with traditional whole life, you don't have a 0% floor. You'll have probably like a 2% floor. Any agent who says you're going to get guaranteed 4%, 6%, 8% is 100% lying. You do not get that kind of cash growth on the guaranteed side with whole life. So please, if you have anyone telling you that or telling your customer that, let me know. I can give you all the talking points. I used to sell whole life insurance. Still do, but just not as much. They do have stable premiums though. You pay the premium, you get the death benefit. It's like permanent term from that standpoint. You got guarantees built into it. But when you talk about the cons, a lot of the cons like a much higher initial cost. So unless you get whole life at a younger age, it's going to be significantly more expensive, even against the other permanent chassis products. Again, there's pros and cons to all of them. It is a complex feature, and some people, even when you equate the conversation, and we'll do a whole dialogue on whole life by itself, but I'll rattle the cage here 1 second when we talk about, complex features. So when you think about permanent insurance, you think about index universal life policies, you're dealing with cash value in dollars. Well, in whole life, they're not dollars, they're units. So you have units of cash versus dollars. And that can be a huge issue. Younger, yeah, 45. That's extremely young. I'm 43, so younger ages, 45, absolutely. So, but yeah, so when you think about the components of complexities in the features, you have a situation where you have people who say, for example, say want to pull out $30,000 from their whole life policy. Well, you're pulling out units to equate to the 30,000 of cash in your hand, but you might lose $45,000 in actual death benefit. It's not a dollar for dollar reduction. So there's some differences there which make it a little bit more complex. But a lot of people, if you talk to a New York Life agent, a Northwestern agent, they don't know these things or don't want to tell you these things because they don't want to make it too complex. But yet they're very quick to point out the 0% column in an IUL. Funny. Cash does grow gradually. I would say it's kind of like the turtle versus the hare. In this scenario, they are definitely the turtle. And so what you'll find is that some people like that slow and steady wins the race kind of thing. Um, yeah, like, so why is it a con? Vipul, great question. When you have gradual cash growth, some people might think that, and I mean, when you talk to certain people, they want to get double digit returns. They want to get, higher returns for their quote unquote investment. That's why I don't like calling insurance investments, even though there is a value proposition of growth of cash. But the thing is that in these scenarios, the cash value growth inside a whole life would be treated almost like a CD, not even a bond, but a CD with a very low rate. Exactly. So that's not the purpose of life insurance, but the hard part is, when people talk about life insurance now, especially on these TikToks and Instagrams and all the other stuff, they want to talk about the cash value and they want to talk about the retirement. Why? Because a lot of people, let's be honest, we're all greedy. We all care about what's in it for us. When the initial point of life insurance was that last love letter you give to your family. So, in order to sell policies, some people have to tug on the heartstrings. Other people try and do the other way around and talk about accumulation opportunities. And you're really just not going to see it with whole life compared to some of the other engines. So how cash works, a portion of each premium payment is allocated to build policy's cash value. So you're going to have the carrier, they're going to take out their fees, their charges, and then you're going to have another piece going in towards cash. That cash does grow tax deferred, and then the policyholder does have access to that cash, which we would typically see the customer borrow or take a loan against it versus actually withdrawing it. Why is that? Most carriers will actually have a charge correlated with the withdrawal of money. Whereas when you take a loan, there typically is no charge, but you want to also make sure you're looking at what type of loans you have, what type of risk tolerance does the client have, and from that, you want to understand what the parameters are. Like whole life has two different types of loan structures. There's direct and indirect recognition. Direct recognition means you're pulling the money completely out, and so it's not going to get any type of return, no dividends attached to it. Indirect, they do have the ability to get dividends from that borrowed money still, almost like a standard loan with IULs versus participating. Very similar from that standpoint. So you have to, your clients have to understand what they've purchased as well. So it's a very complex thing. You can use it to borrow, so take out a loan against cash value for major expenses, college, buying a car, down payment on a house. Maybe you're that entrepreneur who wants to, I don't know, build the most magical place in the world, like Disney. Walt Disney actually took proceeds from his whole life policy to build Disneyland. So there is that. Ray Kroc used cash value from his life insurance policy to buy out the McDonald's brothers and franchise McDonald's. So you can borrow and use it for certain needs and benefits. Some people can use it as a retirement supplement. So once again, anytime you want to take money out, make sure that you as agents talk to your client about the ramifications of what happens if they take that money out. What will it do to the future value of the policy? What will happen if they want to take more money out later? You want to make sure, especially if it's a retirement supplement, that you have that constant communication with it because it is a more complex sale. Premium payments, some people just want to put a lot of or stuff a lot of cash in, so eventually the cash will pay for the premiums. So that's typically what happens with dividends. Dividends grow and accumulate over time and help when it comes to reduction of premium. Now, if you did a typical dividend premium payment option, you're probably looking at 30 years before the dividend will equal the premium. Most whole life agents will say, oh, you can stop paying after 10 years. What happens to your policy is with dividends, it increases over time. And then you'll see this roller coaster effect where the death benefit will start going down because someone stops paying after 10 years and the dividend is supposed to pick up the extra, and there's just not enough there. So the policy will continue to go down until the dividend equals exactly what, the premium is. It's a little funky. So once again, understanding the products, whether you like to sell more IUL, understand your competition and what they're telling the client, or if you like selling whole life, just understanding the differences when it comes to actually using a dividend to pay for a premium or supplement for a premium. Interest does accrue. So depending on how you have it, so I know Northwestern Mutual has a contractually fixed 8% loan. And the idea is they're always saying, oh, well, the dividend should pay for the interest. That means your dividend has to be over 8%, and their dividends haven't been over 8% in about 20 years. So there's always questions or concerns from that standpoint of, can the dividend support, is there enough paid up additions to support you taking out loans? And any impact, or the death benefit will have an impact based on any unpaid loans that you have, or interest. So if I borrowed 50,000 on a $200,000 policy, not using units of measurement, because again, whole life is units, not dollars. We'll just say 200 minus 50,000 loan, 150,000 goes to the next generation. Same thing. A lot of people, when it comes to doing reviews on policies, uh, here's a little tip. You not only want to do a policy review, but maybe you want to talk to your clients about a beneficiary review. Reason being is that I actually have one of my agents has a client who unfortunately just passed away last month, and they have a Northwestern Mutual policy. And in the mail came a letter that said that there was a collateral assignment on the policy. Now, for those who don't know what collateral assignment is, I have $1 million, permanent policy. Say I have a loan I want to take to go buy a business or build a business. Well, the carrier will say, well, the loan officer will say you need to get a life insurance policy because if you pass away, we need some type of collateral to collect in that case. And then you have what's called a collateral assignment. So you sign over a documentation saying that Bank X is the first right of refusal for this death benefit. So someone might have $1 million death benefit, pass away, spouse is thinking they're going to get $1 million, and next thing you know, they get nothing, or 100,000 or 50,000 or whatever, depending on how much of the loan was paid off. But when you have a collateral assignment, that that bank has first right of refusal on how much money they get or what they're owed. And someone always asks this, so I'll just say it right in advance. A bank will not just take all the money, they only take what's owed to them. So don't worry about, a bank trying to take more than what's their worth from that standpoint. So carrier specific product features, different life insurance carriers offer variations in term and whole life. We kind of addressed that as we went through this process. Some people will have dividends. So there are some whole life companies that do not have dividends. I would never, ever, ever buy that, but some people have it. But what the big thing is that what we have to always be as stewards of this industry. We have to always keep learning because product features change all the time. And that's why I love it, because you got to stay on your toes. There's always something new, something different. You also have to see kind of what is going on in the government, because all of that stuff can dictate or change how we do this. That's why, I'd highly encourage, if you're not part of it, to probably reach out to your local NAIFA chapter, NAIFA. They're the ones who have helped keep death benefits tax-free from government. They're your lobbyists to help make sure life insurance does what it's supposed to, and the government doesn't dip their hands in it. So things like that, you can get updates on industry stuff from your NAIFA chapters as well, and it's definitely worth getting involved if you haven't. Carrier specific product features. Again, we talked dividends. We've kind of dabbled into that throughout the presentation, but the actual definition of dividends is a partial refund of your premium. So a lot of people don't realize that you're getting a partial refund of your premium back, partial because they have some going to cash value, they have some going to the charges and fees, and then if they've stayed solvent, which all of them do, they give money back to their people because they're a mutual company. You're all mutually beneficial in the product, so you're going to get a dividend back. But most people take that dividend in the form of paid up additions and put it right back into the policy. So you really don't see it. But everyone's like, oh, my policy is growing. Of course it's growing because you're over investing in it. So when to recommend term life, again, people looking for affordable coverage. Again, when we do these trainings, I always tell people that when you listen to these trainings, you want to make sure that you have action items to walk away with. So for example's sake, if we talk term, who would be a good fit for term? People looking for affordable coverage, maybe young kids or young families. They don't have all their priorities set from a saving standpoint. That's doing like a financial needs analysis. But, finding out what the budget is, understanding what their true need is, and making sure it's protected. So if you think of clients who have kids, a job, mortgage, or a combination of the three, that's where a term insurance conversation could happen. Now, for those who are newer to the industry, you think if an average term life case, let's just say, is 100,000 or is $1,000 in annual premium, you write two policies a month, that's $24,000, hypothetically speaking, of commissionable premium that you could get over that year. So if you're doing a part-time side hustle and you just talk to a husband and wife or spouses, I should say, then you have an opportunity to make some decent passive income. And if they have kids, you can talk about, permanent coverage for the kids. So they have a vehicle for a 529 alternative, retirement alternative, whatever. So you could walk away with two, maybe even four for a nuclear family. So example scenarios, young couple with a mortgage, kids, like I said, individual short-term financial obligations. So like if you want to cover your work, and you're 45, the typical time you want to retire is 65. So you want a 20-year term to cover that. That's what a lot of people will do. The other side, whole life, like I said before, you tell me the day you're going to die, I'll tell you the perfect insurance that you need to get to cover that. Most people don't know that. So we want to do something that gives someone lifetime coverage versus something that has an end date. So we're looking at long-term financial planning goals. And when I say long-term, I don't mean a 2-year plan. I mean like a 20-year plan. People have to understand that with life insurance, whether you're using it for cash accumulation or growth, or what it's meant for is to pass on to someone else. You can't look at it after the first year and judge it and say this is a terrible quote unquote investment because these are long-term products, not short-term products. Most of the time, the insurance company is trying to recoup losses for putting the policies in force. They don't make money, they actually lose money, and it takes them about 10 years to recoup it. So, some scenarios here where you would typically see some type of permanent insurance or whole life business owners seeking some type of permanent insurance. You could actually use it as a valuation or benefit to the company, the cash value growth inside of the policy, or leaving a legacy. A lot of people focus on the retirement. I actually like leaving a legacy more. Two reasons. One, it is for the primary definition as to why people buy life insurance to leave a transference of assets to someone, whether to pay off taxes, whether to remember. I always like to say, like my grandparents left me some insurance money, so I'll always remember that. So you want to leave a legacy to the next generation. Best way to do it is tax-free opportunities like life insurance. So it is more of a heartstring kind of story. It's more of a, benefit. And believe it or not, you actually make more on those type of sales. So Monica says, is term plus whole life or IUL a good package to offer to reduce whole life premiums? Absolutely. Now, when we go into some of our other opportunities, you'll find that there are carriers where you can actually buy a blend. So, say a blend between whole life integrated with term insurance inside of it to reduce the cost. You can do that with IULs as well. So there are opportunities there for people if you want to, shave off some of the costs of the permanent. But I like personally, because I used to do research on it, like I would run a traditional whole life policy. So say someone wanted to put 500 bucks per month into a whole life policy and they were looking for $1 million in death benefit. Well, $500 might buy them a 250K policy, but if you started doing like a term perm blend, you could probably get that $1 million policy. But what happens is you don't drive cash as well. Again, if it's focused more on a death benefit side, you don't draw cash as well as you would just doing it as a raw 250K policy and supplementing with term. So there's different ways and different scenarios. It all depends on the complexity of the design because some clients just want to get one policy, call it a day. Other people, as long as you explain it appropriately, they could buy two policies. But the hard part is when people will say, for example's sake, sell a dirt cheap term like a Banner or a AIG, and then sell like a Mass Mutual whole life. Now you have one check going to one place and another check going to another. So consistency is key if possible, if you're doing a joint policy with term and perm. A good question. So here's costs, just again, extremely generic. There is no rhyme or reason to this. So if you go away today and you say, Phil, I ran the numbers and 250K whole life is way more expensive than 150. Yes, it probably is. But the proof of concept is when you look at the cost differential from that standpoint, 25 bucks versus 150, that is an accurate statement from that standpoint. There's a huge difference in cost, but does the client value the growth of almost like buying a house versus renting an apartment? So some common misconceptions, term life can be more cost effective depending on client needs and time horizon. Again, you tell me when you're planning on dying, I'll give you the right coverage. So sometimes you're going to have needs. AIG put out a great marketing piece called the butterfly chart. So you have just as many issues on the back end of retirement as you do on the front end. But a lot of financial advisors will say, hey, if I do my job right, you only need term to age 65. Everything else goes towards investments, and then you'll live safe and sound for the rest of your life off of my investments. So, when you think about it, having some permanent insurance that you might do that combo, like Monica said, part term, part perm, would make more sense than doing 100% in term if possible. Myth number two, cash value accumulation is typically slow in the early years. It isn't slow, but it is a matter of cash surrender value. Now, let's see. If term premium is high due to health issues, say 600 a month, golly, it's a recommended offer perm. I would say if you have that would be probably an older person from a term standpoint. And so then I would look at some of the protection IULs that would be probably close, from that standpoint. So that would be definitely a spot where you'd want to do that. 40, golly. Yes. Yes, let's take that one offline, Monica, and see if we can look at additional options because 600 a month is extremely expensive. So, but yeah, myth number two, cash value accumulation is typically slow in the early years. And it's not that it's slow, it's that, surrender values for say IULs, surrender values are there and they're going to block how much you have access to. So I wouldn't say that's entirely true. Then you have reality number three. many term policies have conversion options and add-on riders? The answer is no. If you do say, if you talk to a client who's like, well, I looked at Lemonade or Select Quote or, whatever, and I saw much cheaper term options than you're providing. Well, that's because Banner, AIG selected term, um, protective, you have Principal, you have Symmetra, you have uh, one other, Pac Life, the PL Promise. All of those really have no conversion privileges or very minimal because they realize that they're basically giving you a dirt cheap term price, and so if you convert the term, because most people, I'll give you the answer to this one, whatever duration of term you buy, most people either convert it, lapse it, within 7 years. So a lot of these carriers will say, hey, we have a conversion privilege for 5 years or 7 years or 10 years. And then after that, it's a really bad product because they think that at that point you have an adverse issue and you're willing to pay more premium for that permanent policy. So it's a big deal from that standpoint. Um, so traditional whole life will pay only level death benefit or death benefit plus cash value built. That's a great question, Jay. And I don't want to. There's always a misnomer about that. So like when you think about what a whole life policy is, okay, think of it like cake. Okay, it's almost dinner time, so I'm starting to think food, but think of it like cake. Okay, you put the premiums in, it's a level death benefit. Now, every time you put a premium in, you're going to stack on top of it these paid up additions, which is like icing on top of the cake. So technically, that cash value that is building inside of it is growing that icing on top of the cake. Now, if you pull the money out, like all the paid up additions, then you're back to that flat level policy, and that's what you get. Now, if you flip the script to say an IUL, if you are running an option B, which is increasing, and you did it the whole time, it's cash value plus death benefit, your net amount at risk never changes. It's actually pretty expensive. But if someone changes it to level, guess what? That level death benefit is your death benefit. It's not the death benefit plus cash. So if you were to equate a whole life policy to, for example's sake, if you were to equate a whole life policy with no dividends, it would be the same as having a level death benefit on an IUL. When you have dividends, it does increase the death benefit, just like you would have with the cash value on an increasing policy in an IUL. Now, there's arguments like what costs more or less. I can make a simple argument that says that an IUL would cost probably half the cost of a whole life policy, but you are accepting risk. So on the whole life, you have no risk. Absolutely none. You pay the premium, you get your death benefit and the dividends, blah, blah, blah. On the IUL side, you are accepting some risk. You are assuming that there is a return that is going to happen that will help you get and achieve your goal. So again, that's why I said in the beginning, I'll say again, there's no bad product, just bad agents. You just got to figure out which product makes the most sense to your client, that comfortability factor. I had a client who was going to do a $7.5 million IUL. And then they said, well, the guarantees are blah. And they're like, I want to see a policy, a whole life policy. I said, sure. So I ran New York Life because we can. And it was 3 times the cost. He's like, no, I'm going to do the IUL. So he's accepting the risk, but from the lack of bias that I had by showing 2 products, 2 carriers, I let the client decide. So now it's not on me to have that onus against me. Now it is on them because they chose to pick that product. So there's a little bit of a cover your own, you know what, if you know what I mean. So again, it always comes down to assessing what your client's needs are, budget, coverage duration, long-term financial goals, risk tolerance, age and health. We are going to, so Valor is beefing up the website. We're going to have a financial needs analysis automated form on the website. So you can send that out to your clients, they can fill it out, and then you'll get it back so you don't have to work on an Excel sheet. So we are beefing up the website, more stuff to come. Stuff like this that we're doing will also be integrated with a learning management system on the site as well. So we'll have courses and things like that too. So I figured I'd just throw a cheap shameless plug in because we're almost at the top of the hour. So again, a lot of factors go into it. I've been doing this for 18 plus years, and not one client has ever been the same. So there are ideal situations for ideal clients, and it's up to you to ask a ton of questions in order to find the right solution for the right client. So once again, serve distinct purposes. Each one has its own need in place. It's essential to understand what your client's goals are. Ask a ton of questions so that way you can also eliminate any rejection that they might pose. So if you kept saying, "Hey, so what do you think about this? What do you think about that?" And then you say, "All right, well, you said this, so here's my response." You flip the computer around and say, this product has X, Y, and Z, which will eliminate your fears and concerns, and now you eliminate the chance of them saying no. So it's beneficial to ask questions, understand the needs, don't push your agenda on them because no one wants to be sold, they want to buy. So I'll open it up. Does anyone have any questions on this? You can put them in the chat if you want. You can open up and just talk if you want. But once again, the idea here is as people are hopefully typing their questions. If not, I'll cut after this. But the idea here is we want to make sure that our agents are bar none the best, most educated, and opportune to serve our clients in our community. I will give you words of encouragement that if you can last more than 2 years and you're trying hard, you have beat 98%, I think, somewhere in there, high 90% range of agents who come in this business think they're going to get rich quick and then leave real quickly too, once they run out of people that they talk to, their warm market. So understand that as you learn these, you're learning the fundamentals. But even me, 18-year vet in this, I still have questions on certain things too. I'm not going to have all the answers. Don't expect you to have all the answers, but understand that every client will value you if you simply say, you know what, that's a great question. I'm going to find out. So, any questions, comments, raw burst of emotion? Was this helpful? Was this good info? Again, we're going to have a conversation next week. Universal Life, IULs. So we're going to dive into that UL chassis and see the other side of the coin. And ultimately, we'll keep building off of that. We'll have more stuff on the training calendar coming up. You'll be able to see that. Um, and ultimately, I just want to say thank you guys for joining today. Did someone come off
Phil,
mute? Have a question?
yeah. Phil, do you have a career? So, for example, if you want to have a term and perm combined,
Yeah.
would it be possible, or are there any carriers who offers like same, like for one carrier you can have a part of term and a perm, and towards the end of the term you can convert into perm rather than having two?
You can, well, so they wouldn't be, yes, the answer is yes. You have some carriers like F&G, you can get an IUL and have a term integrated into it and then convert that term later to a
Hmm.
permanent, so yes, you can. Oftentimes I usually don't recommend those because
Hmm.
in those situations, part of it is for like say higher income with less fees or whatever. So really, the QOL product from Corebridge has the built-in discount package. So you buy two separate policies, say a permanent term, but they'll waive the 75 or $76 policy fee for the term. So there is a discount when you do it that way. You can do up to four subsequent terms. So
Hmm.
permanent, and four subsequent terms or five terms total. So if you want different durations, you could do that and save some money there. So I think they do it the best. Or you could buy a term from one company and a perm from another. I usually don't recommend that due to consistency and just more prodding on the client's end. So, but yes, that is possible.
That is possible. And also, I'm not 100% clear on the difference between IUL and a whole life
Mhm.
because for my relatives they have New York whole life, and we were just talking about it. And what's the difference? Was New York whole life is better than IUL?
It's neither better nor worse. Fatima, yes, this is recorded. I'll post on the site on the YouTube channel. So speaking of which, so Vipul, that could help you with, if for example's sake, I were to show you, New York Life has its own set of product suites, all whole life based. But if you actually go back into my Valor website here on YouTube, what you'll actually see is I did this a long time ago. Infinite banking versus tax-free retirement. It basically goes through the fundamentals of IULs versus whole life. So it's probably what, like 45 minutes or so, but 33 minutes. So it'll actually give you some good insight on how people are using IULs today, how people are using infinite banking or the whole life phraseology. But really, it boils down to this, and this is why I say ask a ton of questions, because if I came to you and I said, Vipul, do you mind having some type of risk? If you said no, then I completely eliminate the idea of IUL because you don't want to have that fear of loss of your death benefit or policy or whatever. Now, if I could share an alternative, like is the focus on death benefit, is the focus on cash growth, and then you weigh out the balances of each, you can make a compelling argument for each. It just depends on a lot of times a New York life agent is captive for whole life policies. So they're going to explain all the benefits of why whole life is better than IUL. And it's far from the truth. They both have their place. And the cool thing is, in our world, we actually have a contract with New York Life. Your first case just has to be 30,000 in premium. But you can sell whole life too. You can sell New York Life, Mass Mutual, Lafayette, so we have those carriers, so we don't have to be biased. We can do whatever we want for the consumer.
I was speaking on mute. No, thanks for that, Phil. Phil, is it possible to have a training session which would actually focus on because there's only X or N number of scenarios what people would have where somebody would say, my focus is income, my focus is protection, I am a risk averse, or I am a risk pro.
Yep.
And based on that, if we have some sort of role play where people said, okay, if a person's needs are this, how do we evaluate a product? Because I'll tell you my experience with some of those things without naming things. People come with a product in mind
Yep.
rather than a view of understanding your needs and then going back and say, I understand your needs. Let me research the products.
Yep. Well, again, that's why I say 18 years of doing this, you're never going to have the same client. So
Yeah.
I equate it back to when I was working in retail and I was selling laptops and desktops and stuff like that.
Mhm,
People get the ads and the flyer and they see this $300 laptop and they're like, "Oh, this will do games, Photoshop, the whole nine yards," and I have to come in and change their perception.
mhm,
So say like, "Hey, at some point they're either going to listen to you or they're going to want what they want." So there are plenty of times where I've talked till I'm blue in the face to someone who wants to justify in their head that what they want is what they want. And so then at that point, they're like, "So it can do this?" I'm like, "Yeah, it can," because I know it's over, but I still walk away with a sale. Now, in
mhm,
the standpoint of what we're talking about on our end, when you talk to clientele, and say they want whole
mhm,
life, sell it. I mean, if that's what they want, then by all means, you have every right to sell it to them because that's what they want. You can show them additional alternatives, but
Mhm,
if they say that they still want the whole life, I'm not fighting it. I'll give them that. Every part, the most important part about it is the death benefit is there when someone needs it the
mhm,
most. And so whether it's term, whole life, or IUL or UL or VUL,
mhm.
the most important thing is making sure that the client is taken care of.
Yeah.
So if they want to pay more for it, by all means, go for it. Yeah,
Okay.
you're right, Raphael. If you don't sell it to them, someone else will. So that's why I say, like, I keep all bias out of this. You can explain everything. They say they want whole
Yeah.
life. A nice way of telling them, like, hey, I understand you want whole life, and I appreciate it. Let me ask you a question. Why do you think whole life is the best product? And sometimes people will say, well, it's a permanent policy. You're like, okay, so you want a permanent policy. There is an actual product, whole life. There's an actual product, universal life, but they're all under the pretenses of permanent insurance. But
Mhm.
most people remember the phraseology of the wording of whole life, and so they will simply say, I want a whole life policy because they want it to last their entire life. So that's why we have to peel back the onion, understand exactly what they're looking for, educate them as much as you can, because let's be honest, you're going to have the know-it-alls, but educate as much as you can, and then give them options. Say, here's a whole life policy, gives you this type of cash growth, fixed premium for this duration of time, and then here's what you get. I wanted to share with you just an alternative here. This is a protection-based index universal life policy, as a full guarantee all the way to 85, 90, even 100 in some scenarios. And you have cash growth based on the S&P 500 return that can actually give you more potential cash growth. You want A or B? Now all of a sudden they decide A or B. If they want to stick with A, by all means, checks cash the same. But if they go B, that's better than saying A or nothing. So it just gives you that opportunity to provide value, and then they still have the chance to pick, which also limits your liability on the back end.
Yep, got it. So I think I need to watch that video on
Yeah,
YouTube.
watch the video. And on Wednesday nights, again, the cheap shameless plug, Wednesday nights, if people want to talk about case design, we can just dive right in and I can do a mass mutual illustration, use that, and then do an IUL, compare and contrast the differences between them. But that's what we do for the Wednesdays is really dive into
Hmm.
the nitty gritties and really just kind of hash things out for the betterment of everybody.
Yeah, makes sense. No, thanks, Phil.
Hey, my pleasure. So, I don't see any other questions. I'm going to stop sharing. I'm going to head out because I've got a meeting here in about 20 minutes. But just want to say again, thank you guys. Really looking forward to a great 2025. You're going to see a lot of cool things from Valor. We're going to have a lot of expansive growth in a lot of different markets and opportunity. So, just stick with us here and, a lot of cool stuff to come. So, thank you. Have a great rest of your day, great weekend if we don't talk, and I'll see you guys next week.